Artificial intelligence is everywhere these days. The entire field is touted as a revolution about to permeate every last corner of the business landscape. But while the growing prospect of AI control over our lives looks more like a dystopian nightmare, there is a business application where the claims of a leap forward just cannot rely on hype anymore, for the precise reason that it can be unsparingly audited. I am of course talking about AI's application to finance. The marketing hoopla surrounding the sector would have us believe the promise of mighty performance generation, basically relying on some grand market hack. So I think it's time for a reality check before jumping on the bandwagon with all the AI fanboys. In this video, we're going to take a look at the AI fund offering landscape. We'll uncover which fund, if any, stands out of the crowd, and especially, we'll answer whether artificial intelligence as a whole truly is justified today as a credible alternative investment building block worth considering and even including in your portfolio. So let's proceed. AI still hasn't gone exactly mainstream in the financial management world. To this day, it is largely confined to a few niche hedge funds and specialized data science firms that provide portfolio solutions for them. The entry ticket is often quite high. As for the retail investor, accessing the space remains fairly limited today in both the scope of the available offerings and the tenure of their track records. But a few funds and ETFs do exist and can be identified as a meaningful sample of what AI can provide in terms of alpha or outperformance. For the sake of clarity, the funds that we will be analyzing today do not comprise those ETFs that invest in AI-related companies and seek to passively index your portfolio to the artificial intelligence industry as a whole. What we are looking to investigate instead are only those funds that use AI as the core proprietary driver for actively managing and rebalancing their portfolios. Our control benchmark for the purpose of this study will be the S&P 500 Index Total Return, ticker SPXT. Our universe of AI funds will be comprised of 6 candidates. The first one is the AI-powered equity ETF, ticker AIEQ, that relies on the EQBot algo running on IBM Watson's platform. The second one is the Wisdom Tree US AI Enhanced Value Fund, ticker AIVL. This is the oldest of them all. It was designed using a proprietary AI model developed by Voya Investment Management. The third one is the Craft AI Enhanced US Large Cap ETF, ticker QRFT, that runs on a factor-driven proprietary algorithm created by Exchange Traded Concepts. The fourth one is the Craft AI Enhanced US Next Value ETF, ticker NVQ, also issued by Exchange Traded Concepts. It runs on an AI-based algorithm that extracts patterns from pricing data, although I could not find exactly what kind of patterns are being extracted. The fifth one is the Merlin AI Sector Surfer Momentum ETF, ticker DUDE, that runs on a black box algorithm created by Some Growth Strategies. And lastly, our sixth fund, the Merlin AI Bull Rider Bear Fighter ETF, ticker WIZ. This one runs on their in-house AI-powered algorithm that uses the well-known concept of rotational trading between 8 ETFs rebalanced on a monthly basis. So now that all of our players are lined up, it is time to compare them. As you will probably have noticed by judging from the inception column, their inception dates are vastly different, spanning from as early as 2006 all the way to the end of 2020. So clearly, we will have to make a two-step comparison in order to keep it fair and normalized. First, we will confront these funds with the S&P 500 head-to-head over the shortest lifespan that these funds all have in common, which is obviously the shortest one, and in this case, starts on December 30th, 2020. And second, we will assess these funds relatively to the S&P 500 over their respective lifespans. The study was conducted through October 24, 2022. And for those of you who are longtime subscribers and went through our free trading education primer, you already know that this performance comparison is obviously not going to focus on the rate of return. Returns alone tell next to nothing about performance. Rather, we're going to assess our risk-adjusted returns by appreciating them against 4 flavors of risk: their beta to S&P 500, their standard deviation, their average drawdown, and of course, their maximum drawdown. So let's start with our cross-fund comparison based on the standardized sample starting at the soonest inception date, which happens to be December 30th, 2020. Luckily, this sample actually turns out to be pretty significant because it contains both the bull of 2021 and the bear of 2022. The following table outlines the various metrics that I just mentioned. For each column, the bolded black number shows the best reading and the bolded red the worst. Let's start with our annualized returns alone. it is pretty apparent that the NVQ ETF tends to widely outperform its counterparts, having scored a great return during the 2021 bull run and having given back next to nothing during the bear of 2022. AIVL does not look as robust over the period, but still comes in as a decent second and manages to save a positive return. As for all of the others, we can see that they vastly underperformed the SPXT index, scoring dismally negative annualized returns as low as minus 14.5% and giving off a pretty poor balance in their ability to switch between risk-on and risk-off trading environments. Speaking of which, let's take a look now at the second and third column and adjust for risk. Maybe the picture will get better. NVQ shows a pretty tight risk reduction during the 22 bear market with a max drawdown capped at minus 16% when all the other funds are dipping as little as minus 20% and as much as minus 36%. That's brutal, especially when looking at the S&P 500 index that dropped no lower than minus 24.5% at its trough during the sample period. Once again, AIVL comes in as a close second. Now merging both return and risk with our MAR ratio, we can get a fair view of the actual performance of these funds over the past 2 years, and the picture remains consistent. Both NVQ and AIVL come out as clear winners. Others are way more chaotic, as is confirmed by their much larger average drawdowns, showing that the recurring pain incurred by their investors is much more acute than in anything outside of AIVL and NVQ. This fact is further reflected in their intrinsic volatility figures as well, with AIVL winning the contest here. It's worth noting though that NVQ appears to be much less stable over the sample, despite displaying less extremes. Lastly, the beta reveals that AIVL and NVQ retain a fairly lower indexation than their counterparts. However, in that case, both the DUDE and WIZ ETFs win the battle, but we shouldn't be misled here, because their poor indexation is only resulting in underperformance. So if anything, we would prefer them to have a higher beta in order to bring their performance closer to that of the index. In the end, the bottom line is that AIVL and NVQ are holding their own over the sample. The other ones are much more afflicted by chaotic behaviors and leave much doubt about what actual edge they are bringing to the table. This chaos is easy to eyeball by looking at their broader equity curves over the common sample period. And here is AIEQ, QRFT, DUDE and WIZ against the S&P 500 index total return. Notice how none of them can hold the S&P 500's performance and yet still display the same noise. As opposed to AIVL and NVQ, it's pretty easy to see now the risk data is known and quantified. But let's move on to our relative study versus the index. This table describes each metric as a multiple of the S&P 500 over the course of each fund's lifespan. For example, for the CAGR column, we would want a higher multiple, possibly higher than 1, as in we would want the fund to generate a higher annualized return than the S&P 500. Conversely, if we pick say the beta column, we would want as low a number as possible in order to keep our relative pegging to the index to a minimum. Once again, for each column, the bolded black number shows the best reading and the bolded red the worst. Here's what we can gather. Clearly, as I said, the 10-year disparity is huge, ranging from 663 to 5,974 days. So whatever our results are, we will need to ponder our findings with this significant measure of reliability and avoid jumping to final conclusions about the youngest funds in the pack. And looking at the CAGR, our outliers are without much surprise the younger ETFs, with NVQ blowing everybody out of the water. But then again, with only 690 days under its belt, we might want to note instead the second best, that would be QRFT with double the realized tenure. Looking at max drawdowns now, yet again, NVQ stands out meaningfully, having realized only 65.3% of the S&P 500 deepest trough. But by factoring in the tenure, QRFT is looking even better despite a slightly higher reading. The average drawdown confirms this bias with NVQ, QRFT and WIZ perking out of the pack to some degree. As for the others, it looks like more drawn out pain had to be endured throughout their lifespan, making them a harder passive buy and hold. It's worth noting here that AIEQ in particular is substantially worse than all of them. Looking at intrinsic volatility now, our outliers come out as AIEQ for the worst and WIZ for the best. Most other ETFs generate the same reading, or just above the volatility of the S&P 500. But looking at their relative volatility, the beta metric indicates that the DUDE ETF is by far the best, closely followed by the WIZ ETF, while all the others are standing somewhere between 0.9 and 1. So when all of that has been said, what are our takeaways? Well, I can count at least 5 of them coming out of that study. Number 1, and I won't elaborate on it because the stats are too obvious for that, Merlin AI sucks. Whether that is from a return or a risk perspective, both the WIZ and DUDE funds appear to be already dead in the water with not much hope for redemption. Yes, it is possible that for some reason they both had a terrible start and that they will magically rise back up. But frankly, after 15 years of building quant models for a living, I can reliably say that should it happen, I would have never seen such drastic a turnaround before. So in all likelihood, I would think that I am better off forgetting about these two already. Number 2, the wide disparity in the performance of AI funds is a testament that not all AI is created equal. These funds advertise very different AI methods and strategies, of course, but being black boxes, it is next to impossible to make a solid choice simply based on a fund's AI headline description. What remains for us as investors is to judge them solely on their output performance, as well as to give them time to mature and prove themselves in case they do look redeemable. So which one would I invest in today based on the findings of this study? Well, if I were forced at gunpoint to invest in AI today, then only AIVL would be somewhat investable in my opinion. I'm saying if I were forced to, because over the course of its long tenure, the MAR ratio of AIVL happens to only be 0.108, when that of the S&P 500 is 0.166, not even close to being compelling. Now, NVQ does look great at the moment and could make an actual investment candidate down the road, but then again, it is way too young at this point for me to draw any conclusive statement about its performance. And that leads me to point number 3. The fact of the matter is that the performance of AI funds as a whole makes for a very underwhelming investment case on average. Going back to our table, we can see that our group generated on average half the return of the S&P 500 while materializing the full amount of the realized maximum drawdown, over 40% extra average drawdown, and about the same volatility while gaining a measly edge in terms of beta. Quite evidently, this leaves a very sour taste when trying to find reasons to invest in AI funds. All in all, I would lean much more towards waiting it out because of takeaway number 4. It appears that the long-term intrinsic performance of AI-driven funds is heavily afflicted by alpha decay. What does that mean? It simply means that the longer the tenure, the closer their risk-adjusted performance converges to that of the universe that they trade. And that's in the best-case scenario depicted by the AIVL ETF. Others have already crapped out way before getting to that older age. And lastly, takeaway number 5, probably the most important takeaway of this study. The fact that the edge of these funds is wearing off over time, meaning that they cannot sustain their risk-adjusted returns relatively to the market, is a dead giveaway of what I explained right off the bat in our series 2, about the true nature of quantitative trading and more specifically, what it is not. You see, the mediocre performance that transpired throughout this study is the epitome of what I desperately tried to convey in this video. Proper quantitative trading is not an exercise in statistical optimization and data processing power. Proper quantitative trading relies on theoretical math and math alone. In order to discover perennial edges that do not decay over time, it should focus on the why of price motion dynamics. By contrast, system modeling based on backtest and heavy data mining blindly seeks correlative processes that focus on the how and the way to build a good-looking statistical artifact in the least amount of time. In doing so, it fails to understand the mathematical rationale that explains the underpinning price mechanics that drive what was discovered. Said briefly, while correct quant trading uses perennial causational mathematics, AI uses correlative data mining instead that grossly relies on sampling bias. That is the reason why the systems created at FX Physics display such lasting, strong edges, whereas alpha decay is a lethal feature embedded in AI systems from the start, one that slowly and unrelentingly degrades their edge over time, and one that could be observed all over that study. Now you will understand where I come from when I explain that I am not worried at all about AI taking over, at least in the investment world. AI simply cannot compete with the human mind. It is a dead science that cannot be salvaged, because it is grounded in the failure to draw its logic from the original creative force that drives human understanding of reality. Because humans do not need a logical precedent to come up with an idea, they can leverage the spontaneous spark of life to extrapolate a process ex nihilo, meaning out of nothingness or a seemingly chaotic process, and still transcend chaos to come up with a coherent explanation of why a process behaves the way it does, and therefore reproduce and capture it conclusively. AI is incapable of such creative thinking. It can only generate iterative thinking. And as such today, AI has much more to do with a big marketing gimmick, one that fails to withstand the test of objective and quantified assessment over time, identically to the overhyped ESG investing scam that I totally unraveled in this video. The AI marketing hype is no different. It does nothing more than wrap up a self-programming, high processing power into something more that it is not. You heard me right. Artificial intelligence is a misnomer. It is nothing close to intelligence. It is a highly proficient copycat at best. So keep focusing on math to design your systems and you will be just fine. You do not need AI, nor does trading performance. I'll talk to you in the next video.